We have already talked a little bit about large versus small caps in the market cap video, but in this video, we're going to dive a little bit deeper into it. First, a lot of the big name large caps are very strong stocks. So for the most part, these stocks generally go up because they are strong, good companies. This is why a lot of 401ks and long-term investors like to be long in the big names like Apple, Microsoft, Amazon. These large caps are classic examples of the trend is your friend. Meaning if you go with the trend or the general direction of the stock, you have a better chance of profiting. You can clearly see an uptrend when a stock is going from the bottom left to the top right of a chart. But then there's some other charts that just go sideways, like these. You can see how it just goes sideways on the chart from left to right. There are some large caps too that will go downtrend or sideways. In general, with the large caps, a lot of people are looking for these strong uptrend moves, whereas a lot of the small caps are usually not very good companies. Yes, they could explode one day and trend up, but just like any startup company, most don't succeed in the end. So a lot of these smaller cap stocks will trend downwards or sideways. So this can bring in a lot of people that want to short the stocks. The tricky part is some of them will often have big spikes, doing well over 100% in a day. These stocks attract what are called the small cap momentum traders. They look for small caps with a lot of volume making big moves so they can trade the big upward direction momentum. On the other hand, shorts love to short these spikes because the stocks are cheap, liquid, and very volatile. And they have the thought process of going with the trend, that this company is not a very good company. You can make huge percentage gains really fast, but you can also lose big percentages really fast. Just remember, the trend is just most likely what will keep happening, but every stock has a mind of its own, and anything can happen at any time, any day. One of the biggest differences between small caps and large caps is the percentage gains and the capital required to trade those. With a large cap, it's going to take a lot of money or a lot of capital to make a stock move. For example, if you were to buy 100 of SPY, the SPY, at $300, that would cost you $30,000. The chances of SPY moving 10% in a day are very slim. It would take a lot of investors to make that move that big. Most likely, it's only going to move 1 to maybe 5% at most in a day. So let's say that you capture a $1 move. You would make $100, buying it at $300 and selling at $301. The capital you used here was $30,000. Now small caps, especially with a lot of momentum, can make 100% moves. So a move from $2 to $3 isn't that unlikely to happen. Now imagine you bought 1,000 of this $2 stock. That's only putting in $2,000. And then if you capture a $1 move, you make $1,000. So there's a big difference between the capital required and the percentage return you can get. But that's it for now, so I'll see you in the next video.